In 1980, the average American home cost about $47,000. The average household income was around $21,000. That means a typical American needed roughly 2 years of salary to buy a home. Today, the median home price is $420,000. The median household income is $74,000. That's 5.5 years of salary, before interest, insurance, or a single repair. And that's if you can even save the down payment, which at today's prices is roughly $84,000 after tax, while also paying rent. This isn't a story about real estate. It's a story about how an entire generation was handed a game where the rules changed halfway through, and nobody told them. Here's what makes this genuinely different from the usual housing complaints. Home ownership in America was never just shelter. It was the primary wealth-building mechanism for the middle class. For decades, buying a home was how ordinary Americans built equity, passed wealth to their children, and retired with something to show for their lives. The stock market was for the rich. Real estate was for everyone else. But today, the median first-time home buyer is 38 years old. In 1981, it was 29. That's nearly a decade of wealth building gone. A decade of equity you'll never recover. A decade your parents had that you simply don't. And the people who benefit from this? They're not villains in a movie. They're just people who bought a house before you were old enough to. So today, we need to answer three things. First, how exactly did we get here? Because this didn't happen by accident. There were specific, deliberate decisions that turned housing from a basic necessity into a financial asset class. Second, who actually benefits from keeping prices this high? Because for every person locked out of the market, someone else is getting richer. And understanding who that is matters more than most people realize. And third, is there any realistic way out of this, or has the trap already closed? Let's go back to the 1970s. After World War II, America went on the greatest home-building spree in history. Suburban developments spread across the country. The government subsidized mortgages through Fannie Mae and Freddie Mac. Interest rates were manageable, and local governments, eager for growth, approved new construction readily. The result was a housing market that largely kept up with demand. Prices rose, but so did incomes. The ratio stayed roughly in balance. Then two things happened, one slowly, one suddenly. The slow thing was zoning. Starting in the 1970s and accelerating through the 80s and 90s, cities and suburbs across America began restricting new construction. Single-family zoning spread everywhere. Minimum lot sizes went up. Height limits came down. Permits became expensive, slow, and politically contentious. The reason was simple human psychology. People who already owned homes didn't want more supply. More supply means lower prices. Lower prices mean their primary asset loses value. So they voted against it, consistently, for decades. And here's the economic reality that makes this so brutal. Housing is the one market in America where the existing owners have almost total political control over supply. You can't vote to stop a new iPhone. You can't block a competitor from opening a restaurant. But you absolutely can, and millions did, vote to stop new homes from being built near yours. The sudden thing was 2008. After the financial crisis, home building collapsed. Developers went bankrupt. Construction workers left the industry. Banks stopped lending for new projects. And when the market finally recovered after 2012, the construction industry never fully came back. The workers had found other jobs. The small developers were gone. The institutional knowledge had scattered. So demand recovered, supply didn't, and prices went vertical. By 2020, America was short roughly 3.8 million homes. Then remote work happened. Everyone relocated at once, and the Fed cut interest rates to near zero. A match, a gasoline tank, and a generation trying to buy their first home. Here's the part of this story that rarely gets told clearly. By 2023, roughly 65% of American adults owned their home. That sounds like a majority, and it is. which means housing policy in America is at its core a democracy problem disguised as an economics problem. The majority of voters are homeowners. Homeowners benefit from rising prices. Politicians who want to get re-elected don't propose policies that hurt the majority. So the system perpetuates itself. But it goes further than individual homeowners protecting their equity. Institutional investors, large asset managers, and private equity firms began buying single-family homes at scale after 2012. By 2022, investors of various sizes owned roughly 1 in every 4 homes sold in America. Now, the numbers on institutional ownership are genuinely debated. Large institutional investors, like BlackRock subsidiaries, own less than 1% of single-family homes nationally. But in specific markets, Atlanta, Phoenix, Charlotte, the concentration is meaningfully higher. And even where it's small in absolute terms, the effect on the margin matters in a supply-constrained market. Every home bought by an investor is one not bought by a family. Every rental conversion removes a unit from the ownership market permanently. And investors, unlike families, don't need emotional satisfaction from the purchase. They just need the math to work, which means they can and do outbid first-time buyers in cash, every time. There's also the construction industry itself. America's largest home builders, D.R. Horton, Lennar, Pulte Group, are publicly traded companies with shareholders who want profits. Building expensive homes in wealthy suburbs generates far better margins than building affordable starter homes. So that's what they build. The market isn't broken, it's working exactly as designed, just not for you. The honest answer is yes, but not easily and not fast. The economic solution is straightforward. Build more homes, a lot more, everywhere. Upzone cities, streamline permits, subsidize construction of starter homes, make it legal to build an apartment above a shop again. Several states have started doing exactly this. California, despite its reputation, passed sweeping zoning reform in 2021. Minnesota legalized duplexes statewide. Montana became the first red state to eliminate single-family-only zoning entirely. These are real changes, and economists broadly agree they'll help. The problem is the timeline. Even if America broke ground on 3.8 million new homes tomorrow, it takes 18 months minimum to build a house, longer in most markets. Which means even the best-case policy response takes years to move prices meaningfully. And in the meantime, the people locked out today keep renting, keep watching equity accumulate for someone else, keep getting older. The average American renter now spends 30% of their income on rent. In cities like Miami, Los Angeles, and New York, it's closer to 50%. That's money that can't go into savings, can't go into a down payment, can't go into retirement. It's wealth that evaporates every month, quietly, permanently, with no return. So here's where we land. The U.S. housing market didn't become a trap by malice. It became a trap by the perfectly rational behavior of millions of people protecting what they already had, at the direct expense of everyone who came after them. The homeowners who voted against new construction weren't evil. The investors running the numbers weren't villains. The builders maximizing margins weren't doing anything illegal. They were all just playing the game correctly. The tragedy is that the game itself is rigged, and the people it's rigged against are the ones who did everything right, got the degree, got the job, started saving, and still can't afford to buy the house their parents had at 28. That's not a personal failure. That's a structural one. And structural problems don't fix themselves. They wait until the people benefiting from them finally have less political power than the people hurt by them. We're not there yet, but the 38-year-old first-time homebuyer of today is going to be a voter for a very long time. If you want to understand how this housing crisis connects to the broader collapse of middle-class wealth in America, we covered that in depth. Link is on screen now. And if you haven't already, the newsletter covers the smaller stories that don't make the cut for a full video, like which cities are actually seeing prices fall and what that means for the national market.